Hello everyone. In the series of the profitability analysis, we are going to discuss another important ratio today, which is called return on equity. Yes, we are going to discuss about the ROE, which is return on equity. This ratio is very important for any potential investor or a financial analyst. So this gives overall picture about the profitability of the company from the perspective of the equity shareholders. So let's analyze more about this ratio, like how this ratios is made and how a potential investor or a financial analyst can use this ratio for their own analysis purposes. So we'll analyze that, interpret it, and we'll just understand what are things we need to consider while doing the analysis. Yeah, so let's begin. So let's understand what is return on equity. So if I say in very simple term, return on equity is basically tells what are the returns company is generating for the equity shareholder. What is the return company is generating for the equity shareholders or on the equity shareholders fund, right? How much return company is generating. So two element, one is the return and equity. So let's understand what do we mean by equity. Equity means equity shareholders fund. Equity shareholders fund. Now, what do we mean by equity shareholders fund? In equity shareholders fund, we include equity share capital and we will include the retained earning, because both belongs to the equity shareholders. So we'll include the equity share capital and we'll also include the retained earning. Both of these elements can be found in balance sheet. So when you look at the balance sheet of the company, you can identify equity shareholders, equity share capital, you can identify the retained earning, and you just take it, that will be your equity shareholder fund or net worth for the purpose of return on equity formula. So this can easily be identified from the balance sheet. Now, what do we mean by the return? So return is basically the profitability, right? So now since we are talking about the equity shareholders, right? So we need to take the profit which are related to the equity shareholders. Yeah. So if you have seen my previous video in which we have discussed in detail about the profitability analysis, like how the profit and loss statement is made, what are the different levels are there, right? So you must be knowing at the lowest level of the profit and loss statement, there is a PAT, right? So that PAT is profit after tax. Means from the company's revenue, once we deduct all the expenses, whether it's operating expense, non-operating expenses, interest, depreciation, tax, after deducting everything, what is left is the profit after tax. But in some of the cases, what happens, like company has the preference share, so they need to issue the preference share dividend. So from the PAT, once we deduct the preference share dividend, right, that is something. After deducting the PAT, what is available, that is something is available for equity shareholders. So that is called earnings available for equity shareholder. So the formula basically is PAT minus preference dividend, right? In order to get the profitability, that will be the PAT minus preference dividend. So basically, if I have to put the formula, so formula would be PAT minus preference dividend divided by equity shareholders fund. PAT divided by minus preference dividend, that is then divided by equity shareholder fund. Now this is, we know from the income statement, we will get this from the balance sheet. So this is basically the overall formula, and since it is depicted or indicated in percentage, so we'll just do multiply by 100. So that's the formula. I'll just write the formula here, okay, because when we are going to discuss in detail, we need to understand the formula also. So equity shareholder fund, right? So now that we are clear on the formula, we need to know, as a financial analyst or as a potential investor, how can I utilize this formula, okay? What analysis I can do or what interpretation I can draw. So let's try to understand. So for what purpose you can use as a investor to analyze, right, or as a financial analyst? So first is the profitability analysis. So that's very obvious, like, because this formula is talking about the profitability, right? It's talking about the profitability for the equity shareholder, profitability for the equity shareholder. So if the company is return on equity, if company ROE is high, okay, or at least if it is positive, okay, if it is positive, it means the company is generating returns, company is profitable because it is generating the returns for the equity shareholder. If it is positive, you can simply draw that conclusion, right? Now, whether a company is earning 5% ROE, 10% ROE, 20% ROE, now whether that is good or bad, that is something we need to analyze. So, as I said, when you are analyzing a company's profitability, right, you cannot take a standalone, you cannot do the standalone analysis and take the decision, right? So, for any profitability analysis, you need to consider two things. First, you need to check the industry standards, right? In the similar industry, what's the industry standards ROE? Because different industries have the different way of working, right? Some are capital intensive industries, some are less capital intensive, right? So some work on the asset, more asset heavy operations, some are asset light operations, right? Service industry, manufacturing, they work on their own way, right? So their profitability percentage are also different, their operating margin, EBITDA margin, the standards are different. So when you're checking the ROE of a company, you need to understand what are the industry standard before you take a call whether the company is doing good or bad. So you need to take into account the industry standard, and you need to compare with the peers. Like, okay, industry standard is this, but how other companies are operating. Based on that, you decide whether company is doing good, whether company's ROE is good or bad, right? But individually, if you see, if the ROE is positive and it's a good level, then company is doing good. That's a like basic analysis you can do and understand. Okay, so to know the profitability, you can use this. But again, just consider these factors. Now the second thing is when you're doing the analysis, so this is again applicable for all kind of analysis, profitability analysis. You need to always do a trend analysis. Like, you cannot just take the figures of a particular year or particular quarter to understand how company is doing, because that will be not be like that is not enough for you to take a decision. You need to do a trend analysis, like how company is doing, whether the company's ROE is increasing constantly, decreasing constantly, or it is like constant, it's the constant, right? Obviously, if the company is ROE is increasing, it means the company is performing good, it means company like operating efficiently, right? Since it is operating efficiently, so that's why it is able to generate the more return for the shareholder. If it is going constant, then it is still okay, but we need to always think about the future, like what company is doing to increase this in future. That is something we need to know. And if it is going down, obviously that's not good, right? But so that is something very high level we understand from increasing ROA, decreasing ROA, or the constant ROA, right? But you need to go into a bit detail to understand why. So let me give you an example. Let's say there's a company whose ROA was like say 10% constant, or more or less 10 11 10 11 something it's going, but suddenly in one year it dropped to 2%. Okay, so it's not like you just interpret the okay, that company is not good anymore. We need to go in detail. Okay, what happened this year? The company's ROE has come down. There may be the reason that company has taken the additional capital, because this is like basically profitability and equity share capitals, equity shareholders fund. So there may be a reason the company has got the additional capital for future enhancement, right? Let's say company has to make a big investment in the manufacturing facility or something like that, so it got the additional capital, but the factory is not established yet, right? So since the factory is not established just yet, maybe it is in process, so it will take time in generating the profitability, right? So it will take time in generating profitability, so your profit would be constant, right? But your equity shareholder fund would have increased, so that's why your ROE may have come down for that period or that year, right? So even if it is going down maybe for 1 year or something like that, you cannot just draw the conclusion superficially. You need to go into detail to understand why it is happening. If everything remains constant, the company's business is going, there's no future expansion plan, there's no change in the let's say there is no change in equity shareholder fund, but still the profit is going down constantly, right? Then it may be a worrying sign, right? So if there's a sudden increase or decrease, right, that you need to analyze what's the reason, right? Or even if it is constant for 1 or 2 years, it is going down, still we need to know the reason, so that we can make a prudent call whether it is really bad or there is something expansion plan are there due to which it is happening. So this is one example I have given. Sometimes what happens is like even the increasing ROA you need to be scrutinized a bit more. The reason being, let's say if we take the similar example that company is having the expansion plan, right? So for the expansion, right, company needs money. So rather than taking that money from the equity shareholders, they have taken money from the debt. So let's say for business expansion, the company needs money, right? So that money can be taken from the equity shareholders or it can be taken on loan, right? They can take on loan. If they take from the equity shareholder, right, obviously this will increase, and if our profits is also increasing, then it may remain constant, right? But if our profit is remain constant and the equity shareholder fund is increasing, right, so then obviously our ROE will go down, overall ROE will go down, right? So let's say in this case, company has not taken money from the equity shareholder, but company has taken the money from debt. Let's say they have selected the debt, right? So if they have selected the debt, then there will not be any impact on the ROE. Their profit may be same, right? If their manufacturing facility has not started, they have taken a loan, but manufacturing capacity or the facility has not started, so their profit will remain constant, right? Equity shareholder fund will remain constant, so this will remain constant. But let's say they have started their manufacturing facility, right, and company is earning good profit. Okay, so their debt has increased, their debt had increased, and equity shareholders fund did not increase, so this remained constant. The PAT will increase, profit will increase, equity shareholder fund will remain constant, right? Profitability will increase because they have started a new manufacturing facility, so they have started earning more profit. So in this cases our ROE will increase, right? ROE will increase. Understood? So what happens is like companies sometimes utilize the debt, okay, utilize the debt, or which is called leverage also, to gain more ROE, because they will get a debt, okay, from debt they will get the money, they will utilize this money in the business and earn the profit. So if your interest rate is less, debt interest rate is less, and you are able to earn more profit, right, then obviously your ROE will increase. ROE will increase because after interest you are still earning more, right? So your ROE will increase. So that's how the company utilize debt to earn more profit. This is called the leverage, right? We are going to discuss in detail about the same in my next video, so that you can clearly understand how leverage can be a double-edged sword, right? It can be good and bad at the same time for the company. That will understand. So this kind of things you need to understand. If it is increasing, right, then also you need to understand why it is increasing. Because like if company is utilizing more debt or getting more debt, so that is okay as long as company has a repayment capacity. But in the long run, like if company is struggling with the cash flow and is not able to repay, then it is going to be a problem. So this need to be analyzed. So trend analysis need to be done. Yeah. Third, basically like if the company is earning good profit and the company ROE is good, then we can say that company is in a good shape, okay, and it may be having like it would be having the good ability to pay debt. So this is something also used, this formula is also used to understand how the company's profitability and whether company would be able to pay debt or not. But again, this has an impact, or this, while analyzing this or taking a call on this, you need to understand the cash flow of the company. If the cash flow is good, then yes, from ROE you can identify, yes, company has a good um, ability to pay the debt. And fourth, an important point, and this is very very important if you are a financial analyst, right? This ROE helps you to take the strategic decision, and one of the strategic decision is about the dividend, whether to pay the dividend to the shareholders or not to pay the dividend. I understand like this is a collective decision, but as a financial analyst, right, the recommendation which can be given, right, or as a finance manager, CFO, the recommendation needs to be given, right, that is sometimes based on this ROE. So what happens, like how company understands or they do or they think is like, if the company is earning good returns, let's say a company is earning 18% ROE, 18% return of investment, so it means for their equity shareholders, right, they are able to generate the 18% return. Whereas in market, let's say if they give this amount or if they give the profit to the shareholders in the form of dividend, and if they invest that somewhere in the FDs or the banks or in somewhere, they would be maximum able to generate the return of 10% or 9%, for example. So what will company think? Okay, they can retain the money in the business, they can retain the money in the business, reutilize that money in the business, and they can give more returns to the shareholder in future. So if the company is earning good ROE, if the company is earning good ROE, they tend to keep the money in the business. They don't want to give more dividend to the shareholder. They want to keep that money in the business so that they can reinvest that money in the business and earn more money for the shareholder. So the shareholders' returns or the values will increase. Shareholders' value will increase in future. So if the company is good and earning more ROE, they tend to pay less dividend, keep the money in business so that they can make more values or money for the shareholder in future. So this is a strategization which is taken based on the company's ROE, right? So these are the things as an investor when you're analyzing a company, or as a financial analyst if you are analyzing, or as CFO you are analyzing, then you can consider this point. On this point you need to analyze. Yeah. So there are few things which you need to consider when you are analyzing this, right? There are few things you need to bear in mind. Okay. First, as I mentioned, cash flow. Cash flow is important element. So the company's return on equity may be good, ROE percentage may be good, but we need to understand whether companies, how the company's cash flows are. The reason being, all this formula, right, this formula is based on the profitability. Profitability comes from the profit and loss statement, which is based on the accrual, right? It is based on the accrual, it is not on cash basis. So we need to do a separate analysis about the cash flow, if the company's cash flow are good or bad, because there are cases or there are instances where company's profitability is good but the company's cash flow is not good, so it poses a threat on the company's solvency in the long term. Yeah. So cash flow also need to be analyzed along with that. Second thing, debt level. So as I said, ROE can be increased if the company is taking more debt, investing in profit, generating returns. So it will cause the increase in the ROE because the profitability will increase. At the same time, the shareholders fund or capital remains constant, it will increase. But when you are analyzing the trend or analyzing the ROE, you need to consider debt level, because the higher the debt level are, there is always a risk, right? There is always a risk. If there are some problems with the company's cash flow, then it will pose a threat on the company's long term viability, right? Financial viability. So the debt level also need to consider. The third thing is, since it is depends on the profitability, right? So companies accounting policies. So again, this ratio is based on the profit which are coming from the profit and loss statement. Now the profit and loss statement is created based on some accounting practices or accounting policies. Those accounting practices and policies can be different. Like different company may be using different depreciation method or life of the asset based on the different laws of that country, right? So it may not be exactly comparable. So these things also you need to bear in mind when you're analyzing the ROE or when you're comparing with the other companies, right? uh, so okay, we need to check the cash flow, we need to check the debt level of the company, we need to check the accounting policies. Yeah. So these are things basically, just a moment. Hmm. So these are the things basically we need to consider in mind before we take a call, right? These are the important things. Now the another thing is like, when you analyze the ROE, so ROE is based on the last element in the profit and loss statement, right? So when you check the ROE and see it is increasing, decreasing, you can understand this at the very high level how the company is doing, right? But whether the company is able to increase the ROE due to its operational efficiency or due to its ability to utilize its debt or utilize the leverage more efficiently, that detail is not available, right? So in order to interpret this ROE or analyze this ROE in more detail, so there is something called DuPont analysis. DuPont analysis. So this DuPont analysis we are going to discuss in our next videos. Okay, this will actually help you dissect this formula. Okay, dissect this formula so that you can analyze the ROE, how this ROE formula is made, and whether the company is good ROE or bad ROE is the result of the operational efficiency and efficiency, or based on the like asset quality, or whether it's the utilization of debt which is causing the ROE to be increased or decreased. It's a very good analysis that will give you overall profitability picture of a company. So this is something we are going to discuss in next video. But I hope from this video you must have understood what is the return on equity, its formula, or as an investor, potential investor, or as a financial analyst, how you are going to utilize or analyze this ROE. So guys, like if you have any question, you can put your comments and I'll be happy to answer those questions. And if you guys like my videos, then videos whatever I have posted so far, then please like and subscribe the channel, and please do provide the comments if you like the video, because it will help me getting motivated, and I'll be more enthusiastic to post new videos. Yeah, so thank you for watching. See you in the next video. Bye bye.